$3.6 trillion. That is how much value evaporated from global markets in 90 minutes. The mainstream financial media looked at the carnage and called it a healthy correction, a technical adjustment, normal market behavior. But when you dig into the data, when you look at the spreads between different markets, when you examine the delivery mathematics at the major exchanges, when you trace the flows of physical metal versus paper contracts, a different picture starts to emerge. And that picture is worth understanding regardless of whether you are bullish or bearish on precious metals. So, in this video, we are going to do something different from what you will see in most market commentary. We are not going to tell you the sky is falling. We are not going to promise you silver is going to $500 next month. We are going to look at the actual data, understand what it might be telling us, and build frameworks for thinking about these markets that will serve you regardless of what direction prices move. Before we dive in, I want to know where you are watching from. Drop a comment right now with your city or country. This community spans every continent and every time zone, and understanding who is here helps me tailor the analysis to what matters most to you. And if you find value in how I break this stuff down, subscribe to the channel. It is free, it takes 1 second, and it helps me know you want more of this kind of content. All right, let me paint the picture of what we are looking at right now, because the numbers themselves tell a story. Silver in New York is trading around $75 to $76 per ounce. That is the price you see when you pull up a quote on your trading platform, when you check the financial news, when the talking heads on television discuss precious metals. But in Shanghai, the same metal is trading at $82 per ounce spot and $85 per ounce in the futures market. Let that sink in for a moment. We are talking about approximately a 10% spread between two major markets trading the same physical commodity. In any normal, functioning market, that spread would be arbitraged away almost immediately. You would have traders buying silver in New York at 76 and selling it in Shanghai at 82, pocketing the difference and in the process closing the gap between the two prices. But the gap is not closing. And that tells us something important. Not definitive, not certain, but important. It suggests that the normal mechanisms of arbitrage are not functioning the way they should. It suggests that there is friction somewhere in the system that is preventing price discovery from working efficiently across markets. The most straightforward explanation for a persistent premium in one market over another is that buyers in that market do not trust their ability to source physical metal at the quoted price elsewhere. They are willing to pay more because they want certainty of delivery. They want actual metal, not a paper claim on metal that may or may not be convertible into physical ounces when they need it. Now, I want to be careful here because it is easy to leap from an observation to a conclusion without sufficient evidence. The premium could be explained by currency factors, by import restrictions, by seasonal demand patterns, by any number of technical factors that have nothing to do with systemic stress. But a 10% premium that persists over time is unusual. It deserves attention. It is a data point that should factor into your analysis, even if you ultimately conclude it means something other than what the alarmists suggest. Let me ask you something. Are you seeing unusual premiums at your local coin shop or bullion dealer? What is the spread between spot price and the actual price you would pay to buy physical silver today? Drop that information in the comments because ground-level data from actual buyers is often more revealing than official market quotes. And while you are engaging, make sure you are part of our WhatsApp community. We share real-time observations about physical market conditions, dealer premiums, wait times, and availability. The link is in the description. It is free, and it is one of the best ways to stay connected with what is actually happening at the retail level. Also, follow Financial Crux on X for daily updates and quick reactions to market moves. The handle is in the description. Now let me talk about the timing of recent price movements, because timing is often where you find the most interesting signals. Silver's sharp decline occurred in a specific window, and that window coincides with the Shanghai market going on holiday for Lunar New Year from February 15th to February 23rd. The largest physical buyers in the world temporarily left the market for over a week. In that gap, selling pressure intensified. Prices dropped sharply. Stop losses were triggered. Margin calls forced liquidations, and a significant amount of long positioning was cleared out of the market. Now, is this a conspiracy? Is some shadowy cabal deliberately timing price moves to shake out retail investors? That is one interpretation, and it is the interpretation that gets the most engagement on social media, because it appeals to our sense of injustice and our desire for simple explanations. But let me offer an alternative interpretation that I think is more useful, even if it is less dramatic. Markets are machines for transferring wealth from the impatient to the patient. They are machines for separating weak hands from strong hands. When liquidity is thin, when major buyers are absent, the potential for sharp price moves increases. This is not necessarily manipulation. It is just the physics of how markets work when liquidity is reduced. Whether the timing was deliberate or coincidental, the effect is the same. Positions were liquidated, stop losses were triggered, and the market now has less crowded positioning going into the next phase. This is why I always emphasize position sizing and having rules set in advance. If your position is sized so that you can survive a 30 or 40% drawdown without being forced to sell, then these kinds of moves are just noise. They are volatility to be endured, not catastrophes to be reacted to. But if you are leveraged, if you have stop losses too tight, if your position is so large that a 10% move causes emotional distress, then you are vulnerable to exactly this kind of shakeout. The market does not care about your feelings. It does not care about your thesis. It just moves based on the aggregate of all orders hitting the book. And when liquidity is thin, small order imbalances can create large price moves. Let me shift gears and talk about something that I think deserves more attention than it typically gets: the delivery mathematics at COMEX. The numbers being cited are striking. According to the analysis I have seen, there are approximately 429 million ounces of silver required for potential March delivery against futures contracts. The registered inventory at COMEX vaults, meaning the metal that is actually available for delivery against those contracts, is approximately 103.5 million ounces. That is a ratio of over 4 to 1. For every ounce available for delivery, there are more than 4 ounces worth of claims. Now, before you panic, let me explain how this system actually works and why it does not immediately collapse despite the apparent imbalance. The futures market is not primarily a mechanism for physical delivery. It is primarily a mechanism for price discovery and hedging. The vast majority of futures contracts are settled in cash, not physical metal. Traders enter long positions not because they want to take delivery of 5,000 ounces of silver, but because they want exposure to the price movement. When the contract approaches expiration, they roll to the next month or close the position for cash. This means the system can function with a fractional reserve of physical metal backing the paper claims. As long as most participants settle in cash rather than demanding delivery, the limited physical inventory is sufficient. The question is, what happens if behavior changes? What happens if a significant percentage of contract holders decide they want physical metal rather than cash settlement? What happens if trust in the paper market deteriorates to the point where metal is perceived as meaningfully different from a claim on metal? This is where the Shanghai premium becomes relevant again. A persistent premium in the physical-heavy Shanghai market over the paper-heavy New York market suggests that at least some market participants are already making that distinction. They are willing to pay more for certainty of delivery. I am not predicting a COMEX default. I am not saying the system is about to collapse. What I am saying is that the mathematics create a vulnerability. And vulnerabilities do not mean crises are imminent. They mean that if conditions change, if behavior shifts, if trust erodes, the system has less cushion than it appears. This is the kind of structural analysis that I think is more valuable than short-term price predictions. Understanding the architecture of the system helps you evaluate risk even when you cannot predict specific outcomes. Let me talk about the relationship between data releases and price movements because I think there is a pattern worth understanding. The CPI data was announced on February 13th. In the days leading up to that release, silver prices were pushed lower. Now, here's the logic that some analysts suggest is at work. If inflation data comes in hot, precious metals tend to surge because they are perceived as inflation hedges. By pushing prices down before the announcement, interested parties accomplish several things. First, they can accumulate positions at lower prices before potential upside from the news. Second, they reset the technical structure. When prices drop, momentum indicators reset, support levels get tested, and the chart pattern shifts in ways that can influence how technical traders behave. Third, they reduce delivery pressure by shaking out long positions that might otherwise stand for delivery. Whether this is deliberate strategy or coincidental timing is impossible to prove, but the pattern occurs often enough that it is worth being aware of. Major data releases often create volatility, and the price action in the days leading up to those releases often seems designed to position for maximum advantage. This is not a reason to be paranoid, it is a reason to be aware. If you understand that volatility often increases around data releases, and that price action beforehand can be influenced by positioning, you can build that into your approach. You can avoid making emotional decisions based on moves that might be temporary noise. Let me zoom out and talk about the bigger picture because I think it is important to understand where precious metals fit in the global financial architecture. While retail traders debate prices and technicals, central banks are taking action. Russia continues to accumulate silver. China and India continue to increase gold reserves. This is not speculation. It is observable behavior documented in official reports. And there is an interesting wildcard on the horizon. There are approximately $300 billion in frozen Russian assets held in Western financial institutions. The geopolitical dynamics around those assets are complex and evolving. But if some portion of those assets is eventually released or converted, there is a reasonable probability that some will flow into gold. Central banks do not operate on the same time horizon as retail traders. They are not trying to catch the next 5% move. They are positioning for decade-long shifts in the global monetary order. And the consistent behavior of major central banks increasing their gold holdings tells you something about how they view the long-term trajectory of fiat currencies. The dollar may experience periods of strength. It may rally against other currencies. But gold and silver have never left the reserve architecture of major nations. They remain foundational assets in central bank portfolios. And when you see nations that have been adversarial to the Western financial system consistently accumulating hard assets, it suggests they are hedging against scenarios that most retail investors do not even consider. This is the structural backdrop against which all the short-term volatility occurs. Day-to-day prices fluctuate based on data releases, headlines, algorithmic trading, and liquidity conditions. But the long-term trajectory is influenced by these deeper flows of sovereign capital. Now I want to shift to something different but related, because while silver has dominated headlines with its historic run, there is another metal that might be setting up for a similar dynamic: nickel. Let me explain why I think nickel deserves attention and why the setup is interesting even if you have never thought about nickel before. Silver's explosive move over the past year was driven by several factors: geopolitical tensions that increased demand for safe haven assets, central bank buying that added another source of demand, interest rate cuts that reduced the opportunity cost of holding non-yielding assets, and most importantly, a structural supply deficit where demand exceeded supply for multiple consecutive years. That last factor, the supply deficit, is the one that tends to create the most explosive price moves in commodity markets. When demand consistently exceeds supply, inventories draw down over time. And when inventories get low enough, small changes in demand can create outsized moves in price. Nickel is now facing a potential shift in its supply dynamic that mirrors some of what we saw in silver. Indonesia is the world's largest nickel producer, accounting for approximately 65% of global supply. That concentration means Indonesia's policy decisions have enormous influence over global nickel prices, and Indonesia has just ordered its largest nickel mine to sharply cut production. The country has set a supply quota of 260 to 270 million tons of nickel ore this year. That is slightly above earlier estimates, but well below the 379 million tons targeted for last year. The largest mine, PT Weda Bay Nickel, is receiving a quota of only 12 million tons this year compared to 42 million tons last year. That is a 70% reduction at the single largest mining operation. Indonesia's motivation is straightforward. They increased production to capture market share and squeeze out higher cost competitors in Australia and New Caledonia, many of whom have been forced to shut down. Now that they have achieved market dominance, they are cutting supply to lift prices. This is not an unusual pattern in commodity markets. A dominant producer increases output to crush competition, then reduces output to capture higher prices once the competition is eliminated. It is the playbook OPEC has used for decades in oil markets. For nickel, this creates an interesting setup. The oversupply that has plagued the market is receding. The dominant producer is deliberately constraining output, and the demand side remains structurally supported by the transition to electric vehicles and renewable energy. Nickel is essential for EV batteries, it is essential for stainless steel, it is essential for renewable energy storage. These are not demand sources that are going away, they are demand sources that are growing. Now, I am not telling you to go buy nickel. I am not making a recommendation. What I am doing is showing you how to think about commodity setups by looking at supply dynamics, demand drivers, and the behavior of dominant producers. The Sprott Nickel Miners ETF, which trades under the ticker NIKL, has already moved significantly. It is up nearly 78% over the past 52 weeks. It is up over 17% year to date. So some of the move has already happened. The question is whether the supply curtailment in Indonesia represents a catalyst for continued strength, or whether the price already reflects that information. I genuinely do not know the answer. Neither does anyone else. What I can tell you is that the structural setup has some similarities to what drove silver's move: supply tightening, demand supported by secular trends, a dominant producer taking deliberate action to influence prices. Whether that translates into continued price appreciation depends on factors that are not fully knowable. How much additional supply curtailment will Indonesia implement? How rapidly will EV adoption accelerate? What happens to the broader commodity cycle? What happens to the dollar? These are questions that will be answered by time, not by analysis. Our job is to understand the setup, evaluate the risk-reward, and make decisions that are appropriate for our individual situations. Let me ask you something. Have you been watching nickel? Do you have exposure to the battery metals space? Or is this completely new territory for you? Drop your thoughts in the comments because I am curious how much overlap there is between precious metals investors and battery metals investors in this community. Let me bring this back to frameworks because I think frameworks are ultimately more valuable than any specific analysis. Here is a framework for thinking about commodity markets that I find useful. First, understand the supply side. Who produces this commodity? How concentrated is production? What are the incentives of the major producers? Are they increasing or decreasing output? What would cause them to change their behavior? Second, understand the demand side. What are the primary uses of this commodity? Are those demand sources growing or shrinking? Are there secular trends that support demand regardless of short-term economic conditions? Third, understand the inventory situation. What are current inventory levels relative to historical norms? Are inventories building or drawing? How many months of consumption do current inventories represent? Fourth, understand the paper versus physical dynamic. Is there a futures market? How does the paper market behave relative to physical prices? Are there premiums or discounts in different geographic markets? What might those spreads be telling you? Fifth, understand the macro context. What is happening with interest rates? What is happening with the dollar? What is happening with broader risk appetite? How might these macro factors influence flows into or out of this commodity? Sixth, understand the timing. Are there seasonal patterns? Are there major data releases or events that could create volatility? Are there liquidity gaps when major players are absent from the market? If you work through these questions systematically for any commodity, you will have a much better understanding of the setup than most market participants who are just reacting to price movements and headlines. Let me apply this framework briefly to silver in its current state. Supply side, silver mine production has been relatively flat. There are limited new major projects coming online. Primary silver mines are relatively rare since most silver is produced as a byproduct of other mining operations. Demand side, investment demand has been strong due to monetary concerns and inflation hedging. Industrial demand remains robust, particularly from solar panel manufacturing and electronics. The structural supply deficit has persisted for multiple consecutive years. Inventory situation. COMEX registered inventories are at relatively low levels. The ratio of paper claims to physical metal is elevated. Shanghai premiums suggest tightness in physical markets. Paper versus physical. The persistent premium in Shanghai over New York is unusual and suggests friction in arbitrage. This could indicate stress in the delivery mechanism or simply reflect different local conditions. Macro context. The Federal Reserve has pivoted toward rate cuts. The dollar has been under pressure. Geopolitical tensions remain elevated. Central banks continue to accumulate precious metals. Timing. We just went through a liquidity gap during the Shanghai holiday. We had a major data release with CPI. We are heading into a period where March delivery obligations become relevant at COMEX. Working through this framework does not tell you what price will do tomorrow, but it gives you a structured way to think about the setup and evaluate whether the risk-reward makes sense for your situation. Let me spend a few minutes on something that I think is underappreciated. The difference between price and value. Price is what you pay. Value is what you get. When silver drops from $80 to $76, the price has changed. But has the value changed? The physical properties of silver have not changed. The industrial applications have not changed. The monetary properties have not changed. The supply deficit has not changed. The central bank behavior has not changed. If value has not changed but price has dropped, that is either a buying opportunity or a signal that the market knows something you do not know. This is where intellectual humility becomes important. The market can be wrong, but the market can also be incorporating information that you have not yet processed. The challenge is distinguishing between the two. One way to approach this is to ask what would have to be true for the price decline to be justified. What fundamental change would explain the move? In the case of silver's recent volatility, was there a fundamental change that justified an 11% single-session decline? The Russia headline about potentially returning to the dollar system was quickly denied. The CPI data came in soft. Industrial demand has not collapsed. The supply deficit has not reversed. If you cannot identify a fundamental change that justifies the price move, then the move is likely technical in nature. It is likely driven by positioning, by liquidity, by algorithmic trading, by stop-loss cascades. And technical moves often reverse. This is not a guarantee. Sometimes technical moves become fundamental moves because they trigger changes in behavior or sentiment that persist. But as a starting framework, asking whether fundamentals justify the price action is a useful exercise. Let me talk about one more thing before I wrap up. The psychology of watching markets during volatile periods. When silver is dropping 10% in a day, there is a very human tendency to assume that the market knows something you do not, to assume that the price action is telling you that you are wrong, to feel the urge to sell, to get out, to stop the pain. This is exactly the emotional state that shakeouts are designed to create. Whether the shakeout is deliberate or emergent, the effect is the same. Weak hands sell to strong hands. Positions transfer from those who cannot tolerate volatility to those who can. If you want to be on the right side of that transfer, you need to build emotional resilience before the volatility hits, not during it. This means having position sizes that you can hold through drawdowns without panic. It means having a clear thesis that you can articulate for why you own what you own. It means having predetermined rules for when you will add, when you will reduce, and when you will exit entirely. It means having sources of information that help you contextualize price moves rather than amplify your emotional reactions. The best investors I know are often the most boring. They do not react to every tick. They do not refresh their portfolio value constantly. They have a plan and they execute the plan with discipline. When volatility hits, they either do nothing or they follow their predetermined rules. They do not make it up as they go. This is easier said than done. We are emotional creatures. Our brains are wired to react to perceived threats, and watching portfolio values decline feels like a threat. But recognizing that tendency is the first step to managing it. When you feel the urge to sell during a sharp decline, pause. Ask yourself whether anything fundamental has changed. Ask yourself whether you are reacting to price or to information. Ask yourself what you would tell a friend in the same situation. Often the best answer is to do nothing, to wait, to let the volatility pass and reassess when emotions have cooled. All right, let me bring this to a close with some practical takeaways. First, the Shanghai premium over New York is a data point worth watching. It may indicate nothing more than local market dynamics, or it may indicate something more significant about trust in paper claims versus physical metal. Time will tell. Second, the COMEX delivery mathematics create a vulnerability in the system. This does not mean a crisis is imminent. It means the system has less cushion than appearances suggest. Behavior changes could expose that vulnerability. Third, the timing of silver's decline during the Shanghai holiday is consistent with patterns we have seen before. Liquidity gaps create opportunities for sharp moves. Being aware of the calendar can help you avoid getting caught off guard. Fourth, central bank behavior tells you something about long-term positioning that is different from what the daily price action shows. Sovereigns are accumulating hard assets. That is a signal worth incorporating into your long-term thinking. Fifth, nickel is setting up with some structural similarities to what drove silver's move. Whether that translates into similar price performance remains to be seen. But the supply curtailment from Indonesia is a meaningful development. Sixth, frameworks beat predictions. Understanding how to analyze commodity markets systematically is more valuable than any specific price forecast. Before I let you go, I want to hear from you. What is your take on the Shanghai premium? Do you think it is a meaningful signal or just a technical artifact? Are you seeing similar disconnects between paper prices and physical availability at your local dealers? Drop your observations in the comments. And make sure you are connected with Financial Crux across platforms. Join our WhatsApp community for real-time market discussions. The link is in the description. Follow us on X for daily updates and quick reactions to market moves. And subscribe to this channel if you want more of this kind of analysis. Remember, everything you heard here is for education and entertainment. I am not your financial advisor. I do not know your situation. Use this as a framework for thinking, not as instructions for trading. Make your own decisions and own the results. The market will continue to create volatility, headlines will hit, algorithms will react, prices will move sharply in both directions. Your job is not to predict every move. Your job is to understand the structure, manage your risk, and maintain the discipline to execute your plan when emotions are screaming at you to do something else. Silver at $76, Shanghai at 82, 429 million ounces in claims against 103 million available. These are not numbers that demand immediate action. They are numbers that deserve understanding. Thank you for watching. I will see you in the next one.